Hello financial fans, welcome back to another stock analysis. Today we'll be covering Caterpillar, stock ticker CAT. Caterpillar is a multinational corporation that designs, manufactures and sells heavy equipment and engines. The company is headquartered in Deerfield, Illinois, USA and operates in over 190 countries worldwide. Caterpillar produces a wide range of products including bulldozers, excavators, backhoes, loaders, motor graders, mining equipment, diesel and natural gas engines, industrial gas turbines, and generator sets. The company also provides related services such as financing, rental, and maintenance. Caterpillar serves a variety of industries including construction, mining, agriculture, energy, transportation, and forestry. Its equipment is used in various applications such as building roads, construction buildings, mining minerals, harvesting crops, generating electricity, and transporting goods. Caterpillar is known for its commitment to sustainability, safety, and innovation. The company strives to reduce its environmental footprint, improve the safety of its products and operations, and develop new technologies to enhance the products and efficiency. They currently are sitting at a $128.4 billion market cap, and their revenue in 2022 was $59.4 billion. The dividend yield is currently sitting at 1.93%. 45% of their revenue comes from construction goods, 31% from energy and transportation, 18% from resource industries, and the remaining 6% from financial products. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%. It can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction in a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $5.3 billion in 2013 to $7.9 billion in 2022. The average EBIT growth was 3.2%, meaning no change in the margin of safety. The margin has gone up as well, going from 9.57% in 2013 to 13.3% in 2022. The average margin growth was 4.7%, meaning a 5% deduction in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $2.40 a share in 2013 to $4.80 a share in 2022. The average dividend growth on annual basis was 8.2%, meaning a 5% deduction in the margin of safety. This with a payout ratio of 37.2%, meaning no change in the margin of safety. The final two metrics are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Caterpillar, this is just over 2.5 years, in this case a 260% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital for Caterpillar is 11.2%, which is once again no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Caterpillar. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of Caterpillar going from 2016 to 2022. The average growth rate in free cash flow during this period was 9.52%, and I'm projecting an expected growth rate of 8% in their free cash flow over 10 years. With this percentage, we can determine the future free cash flow for Caterpillar and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $152 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $122 billion. To get our intrinsic value out of this model, we just have to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $236.37, which is almost a 5% downside out of this model. The second model we'll be using is the dividend discount model. I've imported the dividend payouts of Caterpillar going from 4 years ago to the current year. The average growth rate in dividends was almost 9% over the past 5 years, and I'm projecting an expected growth rate in the future dividends of 7%, and will once again be using a discount rate of 8.5% in this valuation. giving us a dividend discount model price per share of $342.40, which is a 37.66% upside from the current price. The third model that we use is Graham's advised valuation formula. In this model, we look at the earnings per share that Caterpillar is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the standardized yields of AAA corporate bonds. And we go with a theory that a PE of a company with no growth is always sitting at 7. Looking at all of these metrics, we get a fair value of $196.82, which is almost a 21% downside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we look at similar companies to Caterpillar, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 15.79. All this have to do to get a fair value of this model is to multiply by the earnings per share that Caterpillar is generating, which is $12.63 a share, giving us a fair value of $199.47, which is almost a 20% downside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine these are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been 2.19%, while the current yield is sitting at 1.93%, meaning that it's currently overvalued on this metric. Doing the same with the PE ratio, we get an average PE ratio of the past 5 years of 19.20, while the current PE ratio is sitting at 19.69, which means it's also overvalued on this metric, giving us a fair value of $230.86, which is a 7.18% downside out of this model. If you want to get access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $241.18. A margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the margin growth and 5% for the dividend growth, leaving us with a 15% margin of safety. Applying this margin of safety, we get a fair value of $205.01, and with the current price of $248.72, we get a downside of 17.58%, indicating that's currently a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.